everybody. I thought I'd take a minute and talk to you about adjusting entries. I know that a lot of students are concerned about adjusting entries, but I want to let you know that they're really not a lot more difficult than what we've already covered in this course. A couple of tips that I can give you. The reason we do adjusting entries is because we do accounting on something called the accrual basis of accounting. And the accrual basis of accounting states that transactions and events must be recorded in the period in which they occurred. So if we perform a service in the month of October, we must record that service in the month of October, whether we've been paid for it or not. Another example is an expense. If we have an employee who's working for us during the month of October, we have to record all of the hours that we owe them for October in October, even if the pay date may not be until November. So hopefully that makes a little bit more sense for you. The other principle that takes place during adjusting entries is called the revenue recognition principle. And in the revenue recognition principle, we have to record revenue when the service occurs, not when we get paid for it. So again, if we perform a service for a customer on October 28th, and they say, you know what, I get paid next week, can I pay you then? We still record the service for October, but we'll record the payment in November when we do get paid for it. All right, so let's take a minute and look at the 5 types of accounts that are affected by adjusting entries. So please note there's only 5 accounts that are affected, and each one usually affects only two different accounts. So there's really like 10 things you have to remember for adjusting entries. If you can memorize the 5 types of adjusting entries and the 10 accounts that are affected, this should make things a lot easier for you. Couple of other things. There's always at least one income statement account that's affected. So an income statement account would be an expense account or a revenue account. And there's always one balance sheet account that's affected. So it could be an asset account like supplies or a capital asset like vehicles. One other big important tip, cash is never part of adjusting entries. Okay, so one income statement account, one balance sheet account, and never cash. Okay, so in this little video, I'm going to explain the 5 types of adjusting entries, and then I will do a separate video for what happens if you forget to do them and how it affects your outcome on your financial statements. And then I will also do separate videos for each of the adjusting entries and what accounts they affect and how. Okay, here we go. So the first type of adjusting entry we have to do is for prepaid expenses. Now, prepaid expenses is when we buy something like supplies, for example. When we first purchase them, we're buying something that has value for the company, so we record it as an asset. But as the month goes along, we start to use up our supplies. So we might use up the pencils or the paper, and once we've used them, they don't have value for the company anymore. As a result, we can't really leave them in our asset accounts because that would be unethical or not true, and we want our books to be a true representation of our company. So, pardon me. So in order to do that, we have to take what was once an asset, like supplies, out of our asset account and put it into our expense accounts. Now, in some companies, they may say things like prepaid supplies, prepaid rent, prepaid insurance, prepaid advertising. I don't tend to put the word prepaid in front of my assets. If it helps you to understand what you're doing, by all means you can. So, for examples, the ones that you will run into most often in this course are supplies, rent, insurance, and advertising. So again, we buy supplies, but we use them up during the month, so we have to take them out of our asset account and put them into our expense account. The second type of adjusting entry that we're going to deal with is unearned revenue. Now, unearned revenue is a little bit trickier, but let's see if I can explain it for you. For example, we might have a customer that we do a lot of work for, and they may want to give us money in advance for work that we're going to perform later in that month. An example that you guys probably will understand best is tuition. So a student pays the full tuition, let's say $1,800 at the start of a semester, but the school only provides a bit of that service each month. When the school originally receives that $1,800 that you pay for your tuition, we have to put it all into our bank account, right? So we debit our cash. But where do we put the other part of that? Well, that goes into our liability account because this is now a debt that we owe as a school to the student. We're promising to provide that service for the student. So it's the same thing in any other business. If a customer pays you upfront for work you're going to do in the future, it's considered a liability or a debt for that particular company. Some examples that we might run across is a retainer for lawyer fees, insurance premiums, magazine subscriptions, and rent paid in advance by a tenant. So again, you receive money up front, but you have not performed the service yet, therefore it's a debt to the company. Originally it goes in liability. As we work through the month and we start to provide those services, we can take that out of our liability account and put it into our revenue account. So it comes out of unearned revenue and into straight revenue. But, accounting, there has to be a tricky part. So the tricky part is, for insurance and rent, they are both mentioned in prepaid expenses and in unearned revenue. Here's what's tricky. You must read carefully. One of the things I find with my students is that you don't always pay attention when you're reading. Please take a minute and read and reread the questions before you go ahead to answer. If you are the person paying the rent or the insurance in advance, then it's going to be treated as a prepaid expense adjustment, this first one that we talked about here. If a customer or a tenant is paying you in advance for rent or insurance, then it's considered unearned revenue. So again, if we as the company are paying in advance, it's a prepaid expense. If a customer or a tenant is paying us in advance, then it's considered unearned revenue. If you can get those two straight, the rest should be pretty easy. The third type of adjusting entry that we're going to deal with is accrued revenue. Now, accrued revenue can seem really tricky, but I've made it really simple here. This is all I want you to remember. If you're struggling with accounting, if you can remember this, you'll be laughing. For accrued revenue, it's service that we have performed, but the customer hasn't paid us yet. That's it. Now, for those of you who have a better grasp of accounting, I'd like you to understand the nitty-gritty. So the nitty-gritty is, sometimes a company won't invoice its customers until, let's say, the 15th of the month. So on the 15th of October, we send out a bill for all the work we've done from September 15th until October 15th. Then in November, we'll send out a bill for all the work we've done from October 16th to November 15th. What happens, though, is at the end of October, we have to do our financial statements, and we want our financial statements to represent the work that we've done for the full month of October. So what we have to do as bookkeepers is we have to look at our invoices and we have to look at what service have we performed from October 16th until October 31st that we haven't billed out to our customers yet. And that's what goes in accrued revenue. So accrued means gathered or collected. So we've collected or performed all this revenue, but our customers don't even know that they owe us the money yet. So it's revenue that we finished, but we haven't been paid for it yet. All right. So keeping in the same line, accrued expenses. Accrued expenses for the type of accounting that we're doing will mostly revolve around wages or salaries. So same example that I used in the revenue. If we have 5 employees and we pay every 2 weeks, the end of the month might fall between the 2 pay periods. So let's say on October 25th, we pay our employees $1,000 each. Then in 2 weeks' time, we'll pay all our employees $1,000 each again. That's fine for our cash. But what we need to do for our financial statements and the end of the month paperwork is we have to calculate how much time did those employees work for us from the last time we paid them until the end of the month. And again, in the next video, I'll show you how to calculate this out. There's a few different calculations depending on how the company has it set up. But accrued expenses are expenses that we haven't paid for yet, but that took place during the month that we're doing the paperwork for. And then depreciation. The example I like to use for depreciation is buying a new car. Everybody knows that when you buy a new car, as soon as you drive off the lot, the car is no longer worth whatever you paid for it. So let's say you paid $40,000 for that car, you drive it off the lot, it's not worth $40,000 anymore. Maybe it's worth $38,000 or $35,000. That's depreciation. So in accounting, you know that when we buy something of value for a company, it's called an asset. What you have to remember is there's two different types of assets. There's current assets, which are the ones that turn into cash or that we use up quickly, things like cash, supplies, accounts receivable, insurance. Those are our current assets, and that's what we dealt with before when we talked about those prepaid expenses. Depreciation is what we do with capital assets, and capital assets are items that we purchase that are usually more expensive and have a longer lifespan. So things like vehicles, equipment, things like that. Now, when we purchase something, we know that we have to record it at the purchase price. So let's say we buy a vehicle worth $40,000. So when we first purchase it, we would debit our assets for $40,000, our vehicle asset account for $40,000, and we would credit cash or accounts payable or loan payable, depending on how we paid for it. So now, say it's a year later, that car is no longer worth $40,000, and we want our books to be true and accurate. So what we have to do is decide as a company how much that vehicle is worth now a year later. And I'll show you in another video how to calculate the depreciation rate. But let's say that it has lost $2,000 worth of value. So that's the amount we'll work with our adjusting entries. And we will have to do two different accounts. We're going to have to debit an expense account and something called a contra asset account, which I'll explain in the next video as well. So depreciation is taking the value of our fixed or capital assets and bringing them into line by showing that they're not worth the purchase value from when we first bought them. Hopefully this makes sense to you guys. It's really not as challenging as it may seem. There's the 5 types of transactions and normally 2 accounts for each one. So there's like 10 accounts you have to learn. And once you get the process down, I'm hopeful that things are going to go smoothly. See you in the next video.